This is Brad Keithley, Managing Director of Alaskans for Sustainable Budgets. Welcome to the weekly Top 3, the top 3 things on our mind here at Alaskans for Sustainable Budgets for the week of January 5th, 2025. The weekly Top 3 is a regular segment on The Michael Dukes Show. The show broadcasts on both Facebook Live and YouTube Live, as well as via streaming audio from the show's website, weekdays from 6 to 8 a.m. I join Michael weekly in the first hour of Tuesday's show from 6:10 to 7 a.m. for a discussion between the two of us about our 3 issues. We post the podcast of our discussion following the show on the Alaskans for Sustainable Budgets Facebook, YouTube, SoundCloud, Spotify, and Substack pages, also on the Alaskans for Sustainable Budgets website, as well as the project's page on national blog site, medium.com. You can find past episodes of the weekly Top 3 also at the same locations. Keep in mind that in addition to these podcasts, during the week, you can also follow and participate in the discussion with us of these and other issues affecting Alaska's fiscal and economic condition by following us on the Alaskans for Sustainable Budgets Facebook page and through our posts on Twitter. This week, our top 3 issues are these. First, we discuss what we view as the single most important fiscal issue facing the legislature this coming session. Second, we discuss what the impact of a potential new surge in Venezuelan oil development could have on Alaska. And third, we discuss how a recent report from the Permanent Fund Corporation demonstrates that its board continues to overspend and underperform. And now, let's join Michael.
We should just get things cranking here. So, of course, we are 14 days away from the start of the session, and lots of questions as to what we're going to be facing. As far as nobody's talking about a crisis. There was a Bill Wilikowski and Loki Tobin opinion piece yesterday talking about how if just the governor had just given them their SB 113, and but there was no discussion on deficits or anything else. And I mean, we can already see how things are lining up, but your number one here is the most important fiscal issue in front of the legislature this year. Let's get started.
So we're going to have a lot of discussions about fiscal issues during the course of the legislature. The governor still says that he's going to come up with a fiscal plan before the start of the legislature, and hope that the legislature addresses that during the course of the session. Individual legislators have said they're going to, make various proposals with respect to fiscal plans. So there's going to be a lot of fiscal issues going on to talk about. But before we get into the session, I wanted to highlight what I think is the most important long-term fiscal issue that's going to be in front of this session, and make sure that I sort of set that up and keep our eye on it as we're going along. It is the proposal by some in both the Senate and the House to merge the 2 permanent fund accounts into a single account. The proposal to take the earnings reserve and merge it into the permanent fund corpus and set those up as a one account, a proposed constitutional amendment. That constitutional amendment got a lot of hearings last session. It did not pass either. It did not get out of committee on either side, but it sets in both Senate Finance, the last committee, its only committee on the Senate side, and it sets in House Finance, the last committee before going to the floor on the House side. And the proposal is, we've talked about it a lot on the show. There's been op-eds about it. The proposal is to just merge the 2 accounts together, and then set constitutionally a 5% draw. That's what the percentage is in the proposals in the various bodies, to set constitutionally a 5% draw against that merged account going forward. Here's my problem with it, and I've got 2 problems with it. One is it sets Alaska up, creates a backdoor into the corpus, and sets up Alaska to start gradually draining the corpus. Now, people will tell you, oh no, it's to protect the corpus, but they're either lying or they just don't understand. The corpus, as it currently sets, is absolutely inviolate. The Constitution says you cannot spend from it. The Constitution says you cannot do anything with it other than grow it, other than invest it for returns. The only thing you can spend is the earnings reserve, the earnings, the account that catches the earnings that comes off the permanent fund or the corpus as the investments mature. But what this would do is merge the two accounts together and allow a 5% draw against the merged balance. If you don't earn 5% a year, if you don't earn the amount that the amount in earnings per year to fund a 5% draw, you nevertheless can continue to draw 5%. Under the current system, you draw that amount from the earnings reserve. If you drain the earnings reserve, you're done. You can only thereafter, continue to draw whatever is in the earnings reserve, and it constrains you from getting at the corpus. The two account system constrains you from getting at the corpus. I mean, maybe instead of 5%, you're only earning 3%, and so you can only draw 3%. Maybe you're earning 4%, you can only draw 4%. But it constrains you from spending more than the earnings. You can't go back into the corpus to make that difference between 5% and what you're actually earning. Merging the two accounts eliminates that constraint so that you can continue to earn, you can continue to take 5% regardless of whether the earnings reserve, regardless of whether the permanent fund is generating 5% earnings or not.
Right.
The permanent fund has not been generating 5% returns. And so you can easily see a situation in which the legislature, if this constitutional provision passed and the two accounts were merged, you can easily see a situation in which they go back, they use that back door to go into the corpus and start taking additional amounts. The problem with that long term is that you're draining the corpus. You're essentially taxing future generations by reducing the corpus, reducing the earnings power that you have in order to supplement revenues coming into the current generation. And it's just a continuation of what we've seen since the early 2010s. First, we drained the SBR, then we drained the CBR. Now we're in the process of draining the PFD as a revenue source. And this would just be a continuation of opening up the corpus to start being drained. The second, so that's the huge problem.
I just want to
multi-generational problem.
I just want to make a quick point because I was having this conversation the other day during my vacation, unfortunately, but I was having this conversation with somebody when they were talking about that. And I said, this is not about protecting the corpus. This is about protecting the spend. That's really what this is about. I mean, it has nothing to do with, because the corpus, like you said, 100% untouchable at this point. This would make it touchable, and it's about protecting the spend. I'm sorry. Go ahead.
No, that's absolutely right, and it is. I mean, you see a lot of words that people are throwing out: protecting the corpus, modern investment strategy, all that sort of stuff. But at the end of the day, it is exactly that. They want to make sure they get their 5% out of the permanent fund, regardless of whether they have to go into the corpus to do it or not. The second thing this does is it eliminates the incentive for the permanent fund board to do a good job. So right now, the legislature looks at the permanent fund and says, you need to be producing 5%. That's what the POMV draw is. And if you don't produce 5% in earnings, then the earnings reserve is not filling up at the rate it needs to be able to continue to take the 5%. So you've got the legislature looking over the permanent fund board's shoulder saying, you guys need to do your job. You need to maximize returns in order to make sure that we have enough in the earnings reserve to fund the 5% POMV draw. It creates a huge incentive for the permanent fund board. Not that they've felt it much yet. We'll talk about that in the last segment. But it creates a huge incentive for the permanent fund board to do its job. If the legislature can draw the 5% without regard to whether or not the permanent fund is actually earning 5%, it reduces the incentive. I mean, the permanent fund board will sit there and say, oh, we got an incentive to maximize. But you don't really. I mean, the legislature is going to take 5%, is going to get 5% regardless of whether you maximize your returns or not. And so it encourages, it de-incentivizes the permanent fund board focusing on maximizing returns, and incentivizes them to just sort of sit around and claim the per diem or whatever they get, without really focusing on maximizing returns. And we've seen sort of a cover your ass type approach to investments being made by the permanent fund board. Oh, we just don't want things to go down. We don't want to take any risk. So, we're fine with very low returns as long as we don't take any risk. We've seen what that sort of does to the permanent fund board. And I'm concerned that if we pass this constitutional amendment, we would successive permanent fund boards would not have the incentive to continue to grow. So the reason this is the number one issue to me is it's a long-lasting issue. Whatever Governor Dunleavy proposes in his fiscal plan, we'll debate, we'll decide, but it can be changed next year. Whatever Governor Dunleavy, whatever the legislature, proposes for a fiscal plan, we'll debate, we'll decide, but it can be changed next year. This thing can't be. What they're proposing is a constitutional amendment which would constitutionalize merging the two counts into a single account and constitutionalize that 5% draw. They may say it's up to 5%, but come on. We're smarter than that, aren't we?
Right.
We know that if they set 5% as the draw, that they will take 5%. So it is the long-term consequences of this proposal that, to me, makes it rise to number one on the hit parade this coming session.
Any feeling right now before we go? Any feeling on what the breakdown is in the legislature? I know that we just saw that whole thing about the 7 Republicans who are trying to unify behind a unity platform or whatever, and they've said that combining the funds is a no-no. But I mean, that's only 7 of 19 on the minority. Any feel on because I've had a lot of Republicans say, yeah, we need to combine this. And I sit down and I say, do you know why? And that was part of this conversation we were having. And then they were like, oh. It just doesn't seem to be a lot of discussion on this other than this is a great idea.
There's going to be a big push by the fiscal plutocrats in the state, the oil companies and the top 20%, a big push for this because they view it as a way of continuing to dodge taxes. They view it as a way of continuing to have the free money from the permanent fund coming in for government to spend, and them getting off the hook from paying for the expenses that they continue to vote for in terms of spending level. So there's going to be a big push for that, and you can see it from Commonwealth North. You can see it from other sources, the chamber. You can see it from other sources that are gearing up to push for this. It's sitting in the last committees it's going to sit in. The Senate version is a Senate finance version, and the House version is proposed by the House House Majority Leader. And when I've talked to various representatives on the majority side, they've said, "Oh well, he's proposed it. I mean, he's in favor of it, so yeah, it must be a good thing." So I think it's dangerously close. It will take the Constitution requires 2/3 in each body to get a constitutional amendment out. Governor can't veto it. So it's going to take 7 to stop in the Senate and 14 to stop in the House. And we're going to be talking about this a lot, I'm afraid, during the course, whether we can get 7 in the Senate and 14 in the House to stop it.
Yeah, I mean, again, I'm amazed at the number of people who have come up to me over the last 6-8 months and have mentioned this in passing. Oh, we've got to get this done to protect I mean, this is the whole Bill Walker thing again about protecting the permanent fund by raiding the permanent fund. This is the whole, we've got to protect it by doing all this voodoo math and showing all the draws, but none of the deposits in the permanent fund or the ERA. That was his thing when he did all the charts and showed how much money we were drawing out, but then failed to show all the deposits that were going in from the earnings. Same kind of thing. It's that scare tactics, right? I mean, it's the fear mongering, it feels like.
It's a combination of two things. That's part of it. I mean, the misdirect on protecting the permanent fund corpus, absolute misdirect on that. But it's also part of what went behind ranked choice voting, the ranked choice voting proposal. It's good government. People are trying to get out there and say, "Oh, it's good government. It's modern. It's it makes a lot of it's what all these other investment funds and sovereign wealth funds are doing. They're merging everything together and they're drawing at a fixed percent. It's the good government way to be handling the permanent fund." And so you're getting the kind of responses when I talk to people about it initially. People have the same reaction of, oh, well, we need to move into the modern age with the permanent fund, and we need to, adopt these things that Harvard and other places are doing. And my response to that is, have you thought through why Hammond and others, set up this thing in the 2-account system? Have you thought through the protection that gives to future generations? And the answer is usually no. But that Hammond, that was a long time ago. We don't pay attention to him anymore. We're paying attention to what's going on with paying attention to what's going on with Harvard or Saudi Arabia or somebody like that. And so it's some of the same stuff that drove the ranked choice voting debate. And I frankly, I would imagine we will see Scott Kendall and others out in front of this as well. But at its core, it is exactly what you described it, Michael. It is protect the spend. It is protect the ability to draw those revenues from the fund, regardless of whether it's earning 5% or not. Protect the ability to draw that 5% from the fund. Protect the ability to have that revenue to spend, regardless of what the permanent fund corporation's doing. And it's and people don't see that. So the way that I've tried to describe it is to say, look, there's a reason that we set this fund up in a 2-account system, and the reason still exists, and it is to protect future generations, and it's to protect overspending relative to what the earnings are from the fund. Is to protect against drawing into the corpus. And that's what the 2-account system does. It's what it did back in the 1970s. It's what it did in the 80s, 90s, zeros, 10s, 20s. It protects the fund. And what this proposal would do is open the fund up, open a backdoor into the fund to allow people to start drawing from it.
Well, and I think that's that again is the main draw here. This really, they keep saying it's about protecting the corpus, it's protecting that, but this again is the same. It's the same draw that, like I said, that Walker had, which was we want to protect it by taking from you. We want to protect it by taking from you and putting it back, and essentially saying we need to put it in our hands instead of your hands, because that's going to be better in the long run.
This is really going to be a test for particularly for Republican legislators in the House. It's going to be a test. Are you more concerned about protecting the oil companies and the top 20% than the non-resident industries? Are you more concerned about that, or are you more concerned about protecting working Alaska families now and into the future? And that's going to be that this issue, this vote, if it gets to the floor in each body, and it will, this vote is going to be that question. Who are you concerned about more?
We're continuing now. Brad Keithley, Alaskans for Sustainable Budgets, is our guest. There's a lot more to unpack on that. We were getting into that in the break, but we need to move on to number 2 of the weekly top 3 as we move forward. And that is something that probably many of us are not thinking of or haven't thought of. And that was, of course, the attack on Venezuela, the deportation and capture of Nicolas Maduro as the narco-terrorist dictator, I guess. But there are ramifications even for Alaska on what has taken place down in Venezuela. So, Brad, what's the rundown here?
So this is all about oil, and this is all about the potential impact of opening up Venezuela to additional investment and new production techniques, and what that could do to oil. As background, Venezuela is currently producing about 1 million a day. For reference, Alaska is producing about 450,000, 475,000 barrels a day. So Venezuela is roughly double the size of Alaska in terms of current production levels. But that's sort of Venezuela's historic low. They have been as high in the pre-expropriation period, in the period prior to Maduro and Chavez. They've been as high as 3.5, and we're closing in on 4 million barrels a day. So that's a jump of it's like, if you went from 1 to 3.5 to 4, you're talking about adding multiple Alaskas to the oil supply out there in the world. And so people have started speculating or started addressing what that type of production jump could do. Several things to say about it. First is it's not happening tomorrow. Venezuela isn't down to 1 million barrels a day from its historic highs, isn't down to 1 million barrels a day because it's turned off valves or somehow lost markets and can just sort of turn valves, and all of a sudden it'll just all jump out there. All that historic production will jump out there again. That's not what's going on. What's happening is sort of like if you would have let Prudhoe, in Alaska terms, sort of if you would have let Prudhoe go without any sort of investment or attention to new production techniques for 20 years, Prudhoe would be a significantly lower, smaller field than it is today. The reason Prudhoe has an extended life and is continuing to produce at levels that really no one anticipated 10, 20 years ago is because Prudhoe has constant attention, constant reinvestment of new techniques, of new wells, of a variety of new things to keep that field going. Venezuela hasn't had that. And so you can't just jump in. There's not a master valve in there. You just jump in and turn, and all of a sudden, boy, we're back up to 3.5. You're going to have to go in and make up roughly 20 years of underinvestment and inattention to the type of oil that Venezuela produces to get it back up to the historic levels. The reserves are there. The oil didn't go away, but the production techniques they're using and the investment that they've got, the infrastructure they've got to produce it now just isn't capable of doing that. So we're talking about potentially a period of time. Now, we are talking about, a major opportunity here. We are talking about an opportunity to go from 1 million barrels a day to 2 million to 2.5 to 3 million barrels a day. And you don't find that in the world much. You don't find those sorts of new opportunities opening up. So it's an opportunity that, under the right economic circumstances and with the right incentives and with the right feel of security on the oil company's part, not physical security, but security of their investment. It's an investment that people will make. The thing you really need to, in terms of price, the thing you really need to think about, we are currently in a supply glut, and that has had the effect of depressing price. But the supply glut is not expected to last forever. It's expected to last until sometime in the 2030s, and then the demand and the supply are expected to catch back up to each other, and prices are expected to go up. That's been, when you look at the futures market, when you look at the projections made by various entities that do these things, that's been the expectation, that we will suffer through this supply glut and the resulting relatively low prices for a period of time, and then we'll start ramping back up. The timing of Venezuela, which is probably 10 years before you start seeing significant additional production flows, the timing of Venezuela could slot into that picture in a way that keeps that brings additional production on, just as you think you were getting to the end of the supply glut that we're in now. And so it could add additional downward pressure. At that point, we're talking 10 years out, 5, 10 years, 15, 20 years out, bring additional pressure to keep prices down at that point. So for those who are thinking about long-term Alaska, it could have an impact in terms of continuing to keep prices at a level lower than they otherwise would be. Near-term Alaska, no impact from the oil price standpoint. There's one other factor on price. OPEC is always the wild card in this. You never know what OPEC's going to do. And in fact, Venezuela is a member of OPEC. At least they have been up to this point. And OPEC is pretty good at managing their production in a way, their overall production in a way that sort of controls price. Not always. I mean, they prefer the price to be higher than it is now, but they've have some constraints that they've still got in place to sort of prop up price from where it otherwise might be. They're pretty good at managing price within a fairly broad range. If Venezuela does come on with the additional production, one wild card that we don't know what would happen is how would OPEC respond to that if Venezuela stayed part of OPEC. I mean, if that is one of the outcomes of this, then they would be able to help control Venezuela production to develop price. So a lot of factors at work, but generally speaking, we're looking at a 10-year down the road potential impact on price as we otherwise were coming out of the glut.
I'm sorry, go ahead.
Well, the second thing is from an investment standpoint, Venezuela opens up a whole lot of new opportunities. And oil investment isn't limitless. There isn't a limitless amount of money in the world to be invested in oil. And so Venezuela, if Venezuela opens back up and if companies go in and start investing in Venezuela, that's going to take some money out of the oil investment market. And the question is where that shows up, where the delta, where they're pulling that money from. It's not going to come from current Alaska projects. It's not going to come from Willow. It's not going to come from Pica. Those are already sanctioned, and they're going to go through as they're currently sanctioned. But to the extent there would be additional opportunities Alaska out in the future, to the extent somebody makes a big find, or to the extent somebody wants to make incremental investments in Alaska, it could have an effect at the margin on Alaska having enough money to make those additional investments. And interestingly enough, one of the companies that does have some experience in Venezuela and has some interest in seeing Venezuela production increase because they've still got debts down there, or they've still got obligations that Venezuela owes them that haven't been fulfilled yet. One of the companies that is most mentioned about going back into Venezuela is ConocoPhillips. And if ConocoPhillips decided to go back in, that's going to divert some management attention to Venezuela. It will divert some of Phillips's investment monies to Venezuela. It won't affect Willow, but to the extent there's another step out there that ConocoPhillips might have discovered in the absence of the opportunity of Venezuela, it might affect that. Again, that's a down the road thing for Alaska, but something that's out there.
Well, it also makes me ask the question about timing, because there's also a limited and finite window here where if these companies decide they want to invest and the getting's good, so to speak, before the next dictator shows up to nationalize the industries or whatever, there's also a finite window where they may want to pour a bunch of money in now to get as much oil out as possible before the change happens again, right? I mean, there's a timing issue on this as well.
Yeah, there is a timing issue. But there's only so, I mean, Venezuela's let their industry and let their infrastructure go down so much that there's only so much you can do. There's only so fast you can bring it back. I mean, you can't throw the world's population down there to build new things or to re-engineer the fields. And so it really, I mean, you've got to pace these things. You've got to pace investment. So it's if somebody wants to go in, they'll go in, but they'll go in a way that's paced to match the opportunity, match the things that needs to be done. So, yeah, I mean, if ConocoPhillips wants to go in and says, we're gonna start focusing on Venezuela, that's going to have an effect in terms of things beyond Willow. Is it going to start? Right. Is it going to start sapping their attention from focusing on things beyond Willow?
2 minutes, Brad, real quick. What does this mean? You said this is a 10-year window, so it's not immediate. But in terms of a global perspective and the fact that the president continues to want to try and push oil prices down for American consumers and everything else, what is this? How does this play into the short and midterm with this long-term impact that's going to be coming? What does this play in your mind into the pricing on the short and midterm for Alaska?
Oh, I think the short and the midterm keeps responding to the current glut. I mean, the current glut's not going to go away. If somebody bombed the Saudi oil fields, maybe it would, but the current glut's not going to go away anytime soon, and that's going to continue to affect price. And so it just doesn't. I mean, to the extent there are knobs that Trump can twist, or Trump's successor could twist, because we're talking about a time frame well beyond Trump. To the extent there are knobs that they can twist to keep oil prices down, like, have a good relationship with Saudi Arabia and ask Saudi Arabia to turn their knob down a little bit. To the extent that they can twist those, they're going to continue to twist those. But the current situation, next 5 years, is going to be controlled by the current glut.
Ben says, does this mean the U.S. is now a member of OPEC? No. I know they said we're going to be, I mean, we're running the show, I guess, for a limited basis, but I mean, I don't know. I haven't been following this close enough to really know all the ins and outs. But Brad, this doesn't mean that we're members of OPEC, right? It just might be that our huge country might be a member.
But recall that during Trump's first term, we had an oil price issue. We had prices were spiking, and Trump pushed OPEC to get things under control. Pushed hard to get OPEC to bring down price, to do the things that OPEC can do, turn up volumes to bring down price a little bit, or to affect price a little bit. And OPEC's response was, well, you're the world's biggest producer now, U.S. What are you going to do? And Trump made some promises that essentially coordinated U.S. policy with OPEC. Certainly the U.S. didn't become a member of OPEC, and I don't think we're going to do so through Venezuela. But Trump has been known to coordinate when it fits his purposes. Trump's been known to coordinate U.S. policy with OPEC. So yeah, it really. I mean, I'm going to be fascinated by this. One of the things that really has helped OPEC, helped Saudi and others over the years, is this demise in Venezuela production. Saudi, to control price in the way they have, Saudi and others would have had to cut back their production a lot more to keep price levels to avoid price levels dropping through the floor. To keep price levels where they wanted they would have had to cut production a lot more had Venezuela not collapsed. If Venezuela was still at 3.5, then OPEC would have a much bigger problem. The other members of OPEC would have a much bigger problem than they do. So the collapse of Venezuela has been a significant help to OPEC. Now that if we go in and we help OPEC dig out, or we help Venezuela dig out from this current situation, it's gonna be a problem for OPEC, and it's going to be interesting to see how the other members of OPEC. It's going to be interesting to see how they respond. The U.S. certainly will have a lot of interaction with OPEC. I don't think they'll become a member, but they'll certainly have a lot of interaction.
This is an interesting wrinkle, but again, I'm still going back to the president's policies and what he wants and how that might be good for the American consumer as a whole, but it's kind of antithetical to what Alaska is doing as far as trying to continue to generate revenue and make a good return on the stage. And I think that, to me, is the most important and interesting thing here in the short term, is how are the president's policies continuing to affect us in this regard, and what do you think we're looking at here in the short term, next 5 years, as the president winds out his term?
Oh, I think he will do things. I think he wants to leave a legacy of low oil prices, and I think that's one of the ways that he wants to say that he's addressing affordability issues. And I think he will, where he can, I think he will, propose things and do things that increase the supply of oil to keep the price down. I mean, he's opened up all of Alaska, and I'm not sure that's going to result in a whole lot of new investment or a whole lot of new development on its own. But he's opened up all of Alaska, and that's part of what you would do to increase the supply of oil and affect price. He's opened up a lot of the Gulf of Mexico. Gulf of America. He's opened up. He's talking about opening up other regions. So he is at the margins. He's doing what he can to increase the supply of oil in the world, and we'll continue to do that.
Yeah, and that continues, of course, to put pressure on the legislature. They have to try and figure out a way to, again, hence the combining of the funds, et cetera. They have to find a way to continue to protect the same level of spending with a lower amount of revenue coming in because of those low oil prices.
Yeah, it's everything's connected, Michael. Yes, the subject two does connect it to subject one, and some will cite that. Some will say, "Oh, we need to merge the two accounts so we can have access to the permanent fund to continue to have those revenues because oil revenues are going to be, are going to continue to decline. Look at Venezuela. I expect that will be cited as well. To me, they're two separate issues, but
well, and again, the looking at which we're going to get into in number 3 here, the Permanent Fund Corporation not doing their due diligence and not generating the returns that they should. This would be a good solution, but nobody wants to seem to shine a light on this except for you. I mean, you and I seem to be the only ones talking about this over the last 6-8 months, and I'm like, if you guys really want to just spend the way you've been spending, there's one way to get it done, and that's to squeeze the Permanent Fund Corporation to do what they're supposed to be doing. And if they were getting those returns, your money would be there. But yep. I guess we'll get into that here in number 3. We're continuing. Brad Keithley, our guest. It's the weekly top 3, the first weekly top 3 of the year. Man, it's all good. We're on to number 3, which I think is going to be a reoccurring theme this year. And then I have a feeling. The performance of the Permanent Fund Corporation. Brad, give us the rundown here. This is not. We were just talking about how this if they want to keep the spend up, they could do one thing to help keep the spend up, and that would be to increase their revenues from their one major source of money, and that is the Permanent Fund. Unfortunately, it is continually underperformed. And you've got some thoughts on the performance of the Permanent Fund Corporation.
The Permanent Fund Corporation quarterly produces a report called the Management and Investment Fees Report, and that is the fees that the Permanent Fund has paid to outside parties to help manage the fund and produce the returns that the Permanent Fund Corporation is achieving. Those are produced quarterly. They look at a fiscal quarter or calendar quarter. And are an important source of information about how the Permanent Fund is doing. In Christmas week, something like 86 days after the end, 86 days, that's more than 2 months, after the end of the first fiscal quarter of FY26, the Permanent Fund Corporation finally produced their fees report for the first quarter, and it was eye-opening in the sense that we're continuing to go down a road we should not be going down. I sent you a couple of charts, Michael. Do you have?
Yeah, I'm sorry. Give me a second here. I'll pull them up. You could start talking about them. I apologize.
Well, the first one is a bar chart that shows the amount of fees paid by the Permanent Fund since they've been producing their quarterly reports. They started producing these quarterly reports in 2016. You can go back in what they produced and look at the fees they paid since FY16, and you can look now over roughly 10 years of data to see what the Permanent Fund Corporation has been doing. Here it is, and it's eye-opening. The bars are the amount of money being paid on an annualized basis by the Permanent Fund Corporation in fees to third parties to help them manage the fund. And the bars sort of are on a continual upward drive. There's a drop between 2022 and 2023, but then they start going back up again. The latest report for the first quarter of 2026 shows that those fees are now running at a level of $950 million, nearly $1 billion annually, which the $950 million reported for the rolling 12 months through the first quarter is the highest it's ever been in the history of them reporting on the fees. They incurred these fees before 2016, by the way, but didn't report them. And there's some view that what's happened in terms of the growth over time, over particularly the first 5 years, was they started reporting more and more of the fees. Some of these fees are embedded deeply in the investments, and it takes some effort to dig them out. And so some of that growth is over better reporting of what the fees are. But now we're 10 years into the reporting, and we are now reporting, the permanent fund is now reporting $950 million annually in fees. The red line on the chart is the percent of the permanent fund investment, or the percent of the amount available in the permanent fund that's being spent on fees. And as the red line shows, it's gone from 0.3% of a percent, 0.4% in 2016, now up to over 8%, almost a 1.1% of the permanent fund amount is being spent on fees annually. That compares to Norway, for example, that's at 0.04%. If we were spending at the rate Norway reports, our spending this past year on fees would have been $38 million instead of $950 million. So you can see that the Alaska spend is very significant, both in terms of the dollars being spent and in terms of the percent being spent. What is even more interesting to me is a second chart I did as a result of some discussions with others that went back and looked at the performance of the permanent fund in terms of percent return compared to the performance of an S&P 500 ETF, exchange traded fund, electronic traded fund. And the S&P 500 ETF with the longest history is State Street's SPY fund, SPY. That's their trading name for their S&P 500 fund. Vanguard has one, others have one. Generally, I use the Vanguard fund, but that didn't start until 2011. That wasn't launched until 2011. So SPY has the longest history. And I went back and looked at it. A lot of the times that you get into these discussions with people from the permanent fund or people who are defending the permanent fund corporation, they will say, oh, the reason we undertake our approach is because we don't want to go through what would have happened in the 2008 fiscal crisis in terms of the drop in value. And you can see, if you look in the middle of the chart and look at the red line, which is the return generated by SPY, the return generated by the S&P 500 ETF. If you see that, if you look at the red line, you can see, and the blue line is what the permanent fund did. The returns the permanent fund achieved. Now, that was before fees. They weren't reporting fees during that period. So that's somewhat an apples to oranges comparison. But nonetheless, just taking that at face value, you can see that in 2008, there indeed was a deep drop in the returns generated by the S&P 500 ETF. There was a 26% loss during that period. But look at and so that's a fair point. You got to think about that point. But look at what's happened since then, from 2009, during which the red line, the return from the generated by the S&P 500 ETF, the red line jumped back above the blue line, which is the permanent fund. From 2009 to the present, that entire 17 year span, during that period, the red line has been above the blue line. That is the returns generated by the S&P 500 ETF have been above the returns generated by the permanent fund in every year since 2009, except for one, the COVID year of 2002, in which the S&P dropped below the permanent fund for 1 year, and then it bounced back. That entire span, the entire 2009 to 2026 span, has been a period during which the S&P 500 ETF has exceeded the permanent fund. So, yeah, you can look back at the 2008 and say, "Oh, that was bad. We need to avoid that." But the problem is, in avoiding that, the permanent fund has given up the upside of the S&P 500. And if you go back and do the balances through this entire period, There's another chart that I did in last Friday's column that does that. Last Friday's landmine column that does that. If you go back and look through this entire period, the S&P, the balance generated, the investment balance generated by the S&P 500 far exceeds the balance being generated by the permanent funds approach. So yes, the S&P goes up and down, and yes, in some years it's gone down a lot. But in terms of what's been going on generally and what's been producing the best returns over the long stretch of period since 2008, it's been the S&P 500.
Right.
I to some degree, I titled last week's column in the landmine the PFC's Maginot Line investment strategy. For those who know history, they will know that after the end of World War I, the French built what was called the Maginot Line, which was supposed to be hugely expensive, but built this defense mechanism, the Maginot Line, that was supposed to defend against any potential invasion by France ever again. In World War II, at the beginning of World War II, with the Blitzkrieg and with the other advanced technology and advanced tactics that the Germans developed, the Maginot Line was irrelevant. It fell like in a day. The Germans were able to end run it. They were able to overcome it in terms of air power, and it was useless. The French had made this huge investment in it, but it was useless in terms of dealing with the modern era. That's what the permanent fund corporations board strategy is reminding me of. It's reminding me of investing a lot and spending a lot on fighting, on developing the Maginot Line, fighting the last battle, while the S&P 500 and other ETFs are streaking along and producing superior returns, tremendous superior returns.
Yeah.
Ever since that time.
You know what's interesting to me on this chart, again going back to the return chart, it's like the PFD or the PF Corporation is continually showing you, look, we did better. We did better on a year-to-year basis. But isn't investments a long-term game? I mean, if you look at it in a 10-year period or a 15-year period or a 20-year period, as we're looking at this, even though they had some great drops, I mean, again, 2008 is a huge, as a huge example of that. But on the other side, the fact that they're above the line so much, those returns would have outweighed any of those drops, right? I mean, you did the math on where the permanent fund would be today. Instead of 80 billion, it'd be what, 125 billion dollars if they had just stayed with the S&P, with an S&P type fund over that same period of time. It seems like they're fighting an annual battle instead of the long-term investment battle. It seems like that's their excuse here.
Yeah, it's more than that. They're fighting a past battle. They're saying, look at 2008, look at 2008, look at 2008. We're protecting you against 2008. Well, we're now 18 years down the road from 2008. We've only had 1 year in the period since when the permanent funds approach has outperformed the S&P 500 approach, and the superior performance of the S&P 500 prior to that 1 year and the superior performance of the S&P 500. I mean, look at it since 2022. Look at the red line and how it has exceeded the blue line since that time. We're the focus on 2008 is driving an investment strategy that is hugely expensive. I mean, that's how they justify spending $1 billion a year, nearly $1 billion a year in investment fees. Hugely expensive compared to alternatives in the world. And that's what's driving that. I mean, this focus on 2008 is what's driving that, and it's what's driving the focus on, taking safety first, the maintaining these low risk investments and passing up the opportunities that the market's giving you. So it's not so much a year to year thing. It's just the continual focus on this one event in the past that they think is justifies these huge fees and justify an investment strategy that is having Alaska miss out on all of the market opportunities that are out there for everybody else.
I see Ben is making a comment that I've heard in part from other people. Does a permanent fund gaining outstanding return get us more or less government? I mean, but that's a question. I mean, we're getting more or less government now. They're just taking it all from the permanent fund and taking it from the people. I mean, at least, I mean, would it mean a bigger permanent fund for us, or would it mean more government? And that's a different problem. But again, their whole point here in trying to combine the funds is to keep that spending up. If they had 120 million in the permanent fund versus 80 million, they'd have bigger returns anyway. I mean,
Yeah.
Again, this is a problem. And if it's $1 billion a year, how much is that $1 billion compared to the return? How much does that eat into the return every year? If it was only 40 or 50 or $100 million versus $1 billion, how much more would be reported then in the return? So, I mean, I understand what Ben's saying here, but at the same time, we're not getting the biggest bang for our buck.
I mean, one perspective on this, one perspective I would take on this is, look, we're going to spend what we're going to spend, and they're going to take it out of the SBR and CBR and permanent fund dividends, and they're going to try to crack into the corpus, open a backdoor into the corpus to continue spending. And so what building permanent fund earnings would do is relieve the pressure on cracking into permanent fund dividends. It would allow us to rebuild the CBR. It would allow us to rebuild maybe the SBR. It would relieve the pressure on the other sources of revenue that they're using to continue to fund the spending. So, more money to me. More money from investment returns is never a bad thing.
No, because again, you're losing out. And going back to this other chart, if you go back to 2016, and I know you said they weren't accounting for all fees at that point, but from 2016 to 2026, 10-year period, you saw an 80% increase in the fees. 80% in 10 years. That's insane. I mean, that's insane, especially when you look at the returns that they're getting for that 80% increase versus what you would see in an S&P. I mean, it's mind-boggling at that point.
Yeah, at one point, I think in the first segment, I was talking about the Permanent Fund Corporation taking a CYA, cover your ass type approach. And basically what they're doing is saying, look, we're worried about 2008. We're going to protect against 2008. If it ever occurs again, we're going to be there protecting against it. And look, we paid all these fees to all these advisors. Ain't our fault if it goes bad. Ain't our fault if we miss out on opportunities, because we paid all these fees to all these brilliant advisors to tell us what to do on our investments. That's one of the things when Warren Buffett developed the 90-10 approach that we've talked about before on the show, that 90% of which is invested in the S&P, an S&P ETF, and 10% of which is invested in a bond ETF. Buffett said, look, one of the biggest problems out there in the world are investment advisors, because they're always touting their product and saying, right, oh, you're going to earn these superior returns. You just have to pay us a little bit to get that, but you're going to earn these superior returns from our product. And Buffett said that is one of the biggest problems in the investment community, because you're spending all this money on fees. You're not investing the money. You're just paying it in fees, and you're getting these safety first returns. And Buffett said, you look over time, the 90-10 approach is going to produce superior returns at much lower cost, because the ETFs have much lower cost than paying advisors.
Brad Keithley, Alaskans for Sustainable Budgets. Brad, thanks very much. I hope, again, you're feeling better and you continue to recover. We'll talk to you again soon.
Michael, as always, thanks for having me. Well, that's a wrap for another week's edition of the Weekly Top 3 from Alaskans for Sustainable Budgets. Thank you again for joining us. Remember that you can find past episodes on our YouTube, SoundCloud, Spotify, and Substack pages, and keep track of us during the week on Facebook and Twitter. This has been Brad Keithley, Managing Director of Alaskans for Sustainable Budgets. We look forward to you joining us again next week for another edition of the Weekly Top 3.